Hi, welcome to globalinvestorradio.com. Just thought I'd upload some excerpts from Chapter 1 of Jesse Livermore's book, How to Trade in Stocks. And the great thing about this book, it was written by Jesse Livermore himself. These are his own words, not coming from an interviewer or from an article. And the book starts off with a quote: "All through time, people have basically acted and reacted the same way in the market as the result of greed, fear, ignorance and hope. That is why the numerical formations and patterns reoccur on a consistent basis." Jesse Livermore. And Chapter 1, the title of the chapter is Challenge of Speculation. The game of speculation is the most uniformly fascinating game in the world, but it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, or for the get-rich-quick scheme adventurer. They will die poor. Over a long period of years, I have rarely attended a dinner party, including strangers, that somehow did not sit down beside me and after the usual pleasantries inquire, "How can I make some money in the market?" In my younger days, I would go to considerable pains to explain all the difficulties faced by the one who simply wishes to take quick and easy money out of the market, or through courteous evasiveness I would work out my way out of their snare. In latter years my answer has been blunt: I don't know. It is difficult to exercise patience with such people. In the first place, the inquiry is not a compliment to the man who has made a scientific study of investment and speculation. It would be fair for the layman to ask an attorney or a surgeon, "How can I make some quick money in law or surgery?" I have come to the conviction, however, that large numbers of people interested in the stock market and speculation would be willing to work and study to obtain sensible results if they had a guide or signpost pointing them in the right direction. And it is for them that this book is written. It is my purpose to include some of the highlights of a lifetime of speculative experience, a record of some of the failures and successes, and the lessons that each has taught. Out of it all emerges my theory of time element in trading, which I regard as the most important factor in successful speculation. But before we go any further, let me warn you that the fruits of your success will be in direct ratio to the honesty and sincerity of your own effort in keeping your own records, doing your own thinking and reaching your own conclusions. You cannot wisely read a book on how to keep fit and leave the physical exercises to another, nor can you delegate to another the task of keeping your records. If you are to follow faithfully my formula for combining timing, money management and emotional control, as set forth in the subsequent pages, I can only light the way, and I shall be happy if through my guidance you are able to take more money out of the stock market than you put in. In this book I present to you the portion of the public which at times may be speculatively inclined, some points and ideas which have been garnered during my many years as an investor and speculator. Anyone who is inclined to speculate should look at speculation as a business and treat it as such, and not regard it as a pure gamble, as so many people are apt to do. If I am correct in the premise that speculation is a business in itself, those engaging in that business should be determined to learn and understand it to the best of their ability, with informative data available. In the 40 years which I have devoted to making speculation a successful business venture, I have discovered, and I am still discovering, new rules to apply to that business. On many occasions I have gone to bed wondering why I had not been able to foresee a certain imminent move, and awakened in the early hours of the ensuing morning with a new idea formulated. I was impatient for the morning to arrive in order to start checking over my records of past movements to determine whether the new idea had merit. In most cases it was far from being 100% right. But what good there was in it and stored away in my subconscious mind, perhaps later another idea would take form, and I would immediately set to work checking it over. In these times in time, these various ideas began to crystallize, and I was able to develop a concrete method of keeping records in such a form that I could use them as a guide. My theory and practical application have proved to my satisfaction that nothing new occurs in the business of speculating or investing in securities or commodities. There are times when one should speculate, and just as surely there are times when one should not speculate. There is a very true adage: you can beat a horse race, but you can't beat the races. So it is with market operations. There are times when money can be made investing and speculating in stocks, but money cannot consistently be made trading every day or every week during the year. Only the foolhardy will try it. It's just not in the cards and cannot be done. To invest or speculate successfully, one must form an opinion as to what the next move of importance will be given in a stock. Speculation is nothing more than anticipating coming movements. In order to anticipate correctly, one must have a definite basis for that anticipation. But one has to be careful, because people are often not predictable. They are full of emotion, and the market is made up of people. The good speculators always wait and have patience, waiting for the market to confirm the judgment. For instance, analyze in your own mind the effect market-wise that a certain piece of news which has been made public may have in relation to the market. Try to anticipate the psychological effect of this particular item on the market. If you believe it likely to have a definite bullish or bearish effect market-wise, don't back your judgment until the action of the market itself confirms your opinion. The effect market-wise may not be as pronounced as you are inclined to believe it should be. Do not anticipate and move without market confirmation. Being a little late in your trade is your insurance that you are right or wrong. To illustrate further, after the market has been in a definite trend for a given period, a bullish or bearish piece of news may not have the slightest effect on the market, or it may have a temporary effect. The market itself, at the time, may be in an overbought or oversold condition, in which case the effect of that particular news would certainly be ignored. At such times, the recording value of past performances under similar conditions becomes of inestimable value to the investor or speculator. At such times, you must entirely ignore personal opinion and apply strict attention to the action of the market itself. Markets are never wrong, opinions often are. And that's just the first couple of pages from this book here, How to Trade in Stocks, written by Jesse Livermore back in the day. And it's a very good book. I've had it with me throughout most of my years trading, and it's got some very wise words and some great advice in there. And just to finish off, a quote from Jesse Livermore: "A loss never bothers me after I take it. I forget it overnight, but being wrong, not taking the loss, that is what does damage to the pocketbook and to the soul." And that is very, very true. And that is the problem with most traders, that when they make a bad trade, they find it very, very difficult to close out that position. And you have to. Sometimes it will bounce back. 8 times out of 9 it will bounce back, but that 9th time and it doesn't bounce back, that's what Jesse Livermore was referring to about destroying your soul, basically blowing out your account. Okay, I'll upload part 2 in the ensuing weeks. Have yourself a good day, and I'll speak to you soon. Bye for now.